Let me ask you this question. If you had $1.2 million, what would you be doing? I mean, if you're someone younger, someone 20s, 30s, or early 40s, would you be quitting your job? No, think very carefully. $1.2 million is not a lot these days. But if you're maybe in 50s, yes, then it depends on your expenses. Now, today we have an interesting story. 1.2 million, and in addition to that, a fully paid house, a CPF account that looks reasonably good. So if you're interested to find out more, continue watching on. Hi guys, welcome back. I actually picked up this question from Gwen, and I'll use this tutorial to also help you gain more perspectives on what to consider for your own retirement, because this is a good case study. Maybe Gwen, if you're watching this and you find something interesting, also do leave a thumbs up, because I actually prepared this and took the time to think through your case. Now let's run through this together. Gwen is 53 this year and he has two kids aged 12 and 14. Okay, so he's close to retirement, but kids are still fairly young. Monthly expenses about $3,500. Now, that is actually a pretty low amount. That's actually a very prudent lifestyle. I don't know, Gwen, if you are very frugal, I think that's thumbs up to you. Maybe you can actually enjoy a little bit more, because I'll be sharing numbers with you down the road. I think you have quite good savings, but let's get to that in a while. Now, Gwen has also cash plus investments about $1.2 million and CPF of $500,000. HDB fully paid up. Fantastic, no more liabilities. Now, since the house is fully paid, and if you're in a similar situation, consider strongly to move your OA to your SA, simply because there's no more mortgage that you need to pay from your OA anymore. And then if you transfer it to SA, you can actually get higher interest rates. But for Gwen's case, I can actually make some assumptions. The CPF SA is probably already at full retirement sum, which means no more transferring and no more retirement sum top up available already. But there's still a different suggestion, a different route to add more to CPF. Maybe Gwen, if you haven't done that, take note of this. You can actually refund back your CPF if you have used monies to pay off the mortgage along the years. You can actually do a voluntary repayment of your CPF OA, and that will add in your accrued interest. Simply go to CPF and do a mortgage, the refunding of your CPF OA. That will allow you to mobilize some of your free cash to pump it back to CPF OA for higher interest at 2.5%. Thinking of retiring early but feel that amount may not be enough. I think that is where the main question really lies. Is this amount enough or not? Can we quantify it or not? Now, I think we have some numbers to put in already. If expenses is $3,500 a month, going by the 4% withdrawal rule developed by William Bengan, that means a yearly expense of $42,000. You times 25 to it, that gives a $1.05 million required for retirement. Now, Gwen has $1.2 million already. In a lot of ways, that means that he's possibly financially free. But let me highlight a few limitations from the 4% withdrawal rule. Firstly, it assumes that the investment is invested into 60-40 equities and bonds in a portfolio. Secondly, the confidence is for a 30-year time frame. Now, if we do some math to the equation, $1.2 million, and if he wants to consume for $42,000 a year, it can only last for 28 and a half years. And Gwen right now is 53 years old, which means it can only last him to age of 81. Not too bad, but that's also not factoring a few things. This money is not, without interest. The reality is we also have inflation, correct? So let me show you some adjustments with inflation adjusted returns. This is the formula for inflation adjustments. So if you're not familiar with it, look Google search on it, because I'll be diving to the results right away with it. Now, if we put certain inflation adjustments to it, firstly, if the money is kept inside an investment or kept inside, fixed deposit at 1% return, and then there's an inflation of 2%, what does it look like? Now, if you put the inflation adjustment equation to it, the amount can only now last 25 years, shorter from 28 and a half, right? That's simply because inflation is eroding that value a bit faster. Now, if you're thinking, hey, inflation 2% seems very conservative, or if you are watching this from a different country with a higher inflation rate of return, what is going to happen to the equation? So if we plug in the inflation of 4%, for example, that would change the equation drastically, because now we would see that the monies can only last for 20 and a half years. Now, continue following me. Of this $1.2 million, how much is invested and how much is in cash? Because that's crucial, correct? Now, the reply is, Gwen, he's a sole breadwinner. We know now that his wife is not working. Of this $1.2 million, $750,000 is invested into 3 corporate bonds with an average yield of 4%, one of which is having the highest yield, which will mature in 1.5 years' time. About $80,000 is invested in penny stocks bought many years ago. The rest is in cash. If we do the math out, that means the cash holding could be about $370,000. Now, I have a few comments to make on the investment strategy so far before I get further. Corporate bonds, if you're not too familiar with it, corporate bonds are IOUs, which means you buy from a company and then the company gives you coupons. I've actually a previous tutorial which I'll link below, just in case you're not too familiar about bonds. I'll explain it in that tutorial a bit further. Now, there are risks when it comes to investing in corporate bonds, simply because when you are putting your money in corporate bonds, you're actually trusting one company to deliver on its promise to return you back your principal, correct? Now, as we have heard of horror stories before, things such as High Flux, things such as NOL, companies that were, supposedly very strong, getting into financial distress. And especially for the High Flux case, retail investors actually saw a loss in terms of principal. So my quick take is, there is concentration risk when it comes to investing in corporate bonds. It's much better to get into bond funds whereby you are diversified. Straight off, you can buy an ABF bond ETF. You can buy funds which has focus and active management to bonds itself. The second part about penny stocks. Now, 80,000 invested in penny stocks. If you are not too familiar of penny stocks are companies whose share price are very low, typically 20 cents or less. And as we know, typically they've fallen off the cliff simply because business operations were not too good. I have an example to show you what could have happened with Gwen's portfolio. This is the company 九天 Chemical. I've covered in a previous tutorial on top 10 dividend stocks of 2021. But this is the history of 九天 Chemical, just as an example of what could have gone on. In 2008, you realize that the price of 九天 Chemical was so high, correct? And it came crashing down. Operations were not good. It was in a turmoil. For the next 10 over years, as you can slowly see, it was a drag. The share price was horrible. Investors lost significant capital, and anyone who is invested would find losses of 50 to 90% depending on their entry period. Now, the problem with having penny stocks is you don't know exactly when to sell, correct? There's always this hope that it recovers and it jumps up again back to your capital. And indeed, for 九天 Chemical in this story, 九天 Chemical has saw a double in terms of its price appreciation because simply it's found business operations and new opportunities with its industry. And right now, it seems that their business is thriving, it's on the uptrend. And if you're an investor, you're not too sure whether to sell out or not, simply because your purchasing price could be 50 over cents, but now from 5 cents it's risen to 10 cents. The question still looms, is it a time to sell? The problem with stock investing, especially penny stocks, is the decision making should not be based on the price or the losses on the P&L. I repeat again, the decision making on holding that company share should be on the prospects and not because of the price trend now. So keep that in mind. I strongly recommend to actually divest everything. If it's a penny stock, change away everything. That strategy doesn't work. Even if some rebound, you're not too sure when to exit. And it could even linger lower and lower. 80,000 is still significant. Rebalance it into funds, get it globally diversified. You would see your capital a lot more protected and there will be significant appreciation. Now, I went on to ask further, is there leverage on the bonds itself? Because right now in the current interest rate climate, it's actually quite favorable to leverage because interest rates are so low. Right now, banks usually charge 1 plus spread, which means your interest cost could be about 1.5%. So it's not surprising that bankers will actually suggest you do use leverage to buy bonds, and the leverage yield could be looking a lot higher. But again, using leverage is a double-edged sword. Make sure you are able to cope if interest rates change and that you have the principal and that you are investing amount that you can lose. So with that, he's answered the question that right now, due to low fixed deposit rates, the bonds are actually fully paid now, which is a bit peculiar because interest rates are low, supposed to be leveraging up, but that's besides the case. The bonds that he actually owns right now are Thomson Medical. Now, if you're not too familiar with bonds, let me go with you on a Google search. Simply key in the bond itself, and what you can find is information. Nowadays, there's Bondsupermart, which can show you the dynamics of the bond itself. And what we can see in this bond is, right now, its maturity date highlighted over there, 18 July 2022, which means principal will be paid back, the 250,000. And then what sector is it? It's in healthcare. And then what kind of type of it? High yield corporate bond means this company is not investment grade. There is supposedly slightly higher risk. If we see in terms of performance, 3-year performance relatively flat because bonds are meant to return you back principal. As it goes towards its maturity date, the price will revert back to the 100. Now the next two bonds are actually SPH perpetual bond and Escort perpetual bond. Now if you're not too familiar what is a perpetual bond, let me try to help you understand it in a simplistic point of view. Perpetual bond means there is no end date to the bond itself, perpetual, which means when you loan this money to a company, there is no end date to when they'll return you back the principal. So typically perpetual bond being so long term, the rates are usually higher in terms of the coupon. So as you can see, SPA perpetual bond pays 4.9%, Escort perpetual pays 3.88%. But I'm not the biggest fan of perpetual bonds simply because when you are investing in a perpetual bond, when the climate is favorable to the issuer might just recall back the perpetual bond. They usually have a callback option, which gives you back this reinvestment risk. If interest rates are low, they might call back the bond to reissue a new one, and then you are given back your capital and you need to reinvest, and it's possibly at a lower rate. On the other hand, if business climate is bad, they are going down the drain, then your perpetual bond could lose in terms of value also. And that's what actually happened to High Flux. So be very careful of using perpetual bonds. Don't assume that that rate of return is going to be ongoing forever and that is guaranteed. The guarantee is from the company itself. Now, before I get to my recommendations, smash the like button so more people can see valuable content like this. And again, inviting you to press on subscribe because I'll be touching more on retirement topics. And if that interests you, how to get to financial independence and retire early, stay on with this channel. Now, let's see back on the CPF portion because I haven't touched much about it, correct? So 500,000 in terms of CPF, if everything's in OA and SA, that means Mr. Gwen can potentially withdraw up to $200,000 from his CPF accounts when he turns 55. That's even factoring the budget required for enhanced retirement sum. So let's add back this 200,000 that he can freely withdraw to his liquid cash, which is 750,000 in corporate bonds, 80,000 in petty stocks, 370,000 in cash, and then 200,000 coming that he can take out from CPF when he turns 55. Now this gives him 1.4 million that he can use quite comfortably and move it around. And as we know, if he is on the enhanced retirement sum, what we can project is from age 65 onwards, he will potentially get about 2,000 per month in terms of cash flow. So that period is quite settled. And I want to solve the equation with this 1.4 million that can be done. I wouldn't be recommending owning the penny stock or the corporate bonds moving forward too much. So if I can restructure, I'll be looking along these general guidelines. The first is how to fix long-term income solution, because now CPF Life is going to give him 2,000 per month, correct? And if he wants from 65 onwards to be settled, a simple way is to get into an annuity. Use an annuity to get in an additional 1,500 per month to bulk the total cash flows he can get to 3,500. If he wants a buffer, maybe get an annuity which pays 2,000 a month from 65 onwards. So in combination, CPF Life gives him 2,000 and annuity gives him 2,000. From age 65, he's settled. Use a big portion of this 1.4 million to solve that first. That makes it a lot easier. Now, the next part is his question on can he retire early? Quite comfortably, yes or so. So because now there's 12 years from 53 all the way to 65, correct? Which means if he needs 3,500 a month, 42,000 a year, if we times 12 to that, that means he should keep 500,000 in terms of cash. And he can just freely use this cash all the way until 65. And then his CPF Life and annuity will settle him for the rest of the life already. Now, if he has still any surplus, my suggestion is then get it invested in a diversified portfolio of equities and bonds. Break it down globally so that your value doesn't become zero. And with that, that gives additional dividends that can be coming to as cash flow. Always remember, when it comes to retirement, it's not the cash you have, it's the cash flow you have from assets that is more important. So hopefully that has benefited him, that has benefited you watching this. And if you have questions also, leave them in the comment sections. If it's a good case study, I'll try to pick up for everybody as a learning tutorial. With that, I'll sign off. Press on the subscribe again. I'll see you in a future video. Take care and goodbye.